The last time global markets saw a currency move of this magnitude, it triggered the 1998 Asian financial crisis, bringing economies like Thailand to a sudden, devastating halt. 28 years later, one of the US Treasury's most tightly guarded secrets has come to light. The United States government has made up to $100 billion available from its own reserves to prop up a collapsing Japanese yen. This tracks the carry trade. Investors borrow massive amounts of yen at near zero rates, pumping that liquidity into American AI infrastructure. As the yen depreciated, the cost of servicing that debt dropped. The further the currency fell, the cheaper it became to repay original loans. These appreciated dollars allowed American capital to acquire Japanese companies, real estate, and technology at a significant discount. Major global investors, including Warren Buffett, secured stakes in the 5 dominant trading conglomerates that control the Japanese economy. Japan had essentially been turned into a bargain hunting ground for global capital. If Wall Street is making a fortune extracting cheap Japanese assets, it's worth asking why the US government would suddenly move to stabilize the yen. The risk lies in the exit strategy. If the yen begins a sustained rally, that massive carry trade unwinds, forcing investors to sell off their dollar-denominated assets and triggering a sharp correction across Western stock markets. To understand why Washington intervened when it did, we have to look past the stock market and trace the crisis back to its root cause, the global flow of energy and currency reserves. Japan is structurally dependent on imported fuel, which must be purchased with US dollars. When global crude oil prices spiked, the cost of bringing those tankers into Japanese industrial ports surged. This chart tracks Japan's central bank liquidity. Liquid US dollar reserves dropped from $160 billion down to under $40 billion in just a few months. To secure the fuel needed to keep the country running, Japanese institutions had to continuously sell yen to buy dollars. That relentless selling pressure caused their domestic currency to plunge even further. When the cash reserves ran dry, Japan was forced into a corner. To keep the lights on, they had to start liquidating their vast stockpile of over $1 trillion in US Treasury bonds. Japan acquired a huge portion of those US government bonds around 2020, back when the Federal Reserve was printing trillions and pushing bond prices to historic highs. This split-screen chart illustrates the inverse relationship between rates and bonds. When the Fed recently raised interest rates, the value of those existing Treasury bonds collapsed. Assets Japan bought for $100 are now worth roughly 60 to 70 cents on the open market. Dumping these heavily discounted treasuries into the open market meant Japan was locking in massive realized capital losses with every single sale. This created a systemic threat for America. The sudden flood of supply caused 10-year US Treasury yields to surge toward the 4.7 to 5.0% threshold. That 5% mark is a historical breaking point. Because US Treasuries are the risk-free benchmark, their yield dictates the borrowing floor for the entire economy. If the government pays 5%, then mortgages and corporate loans must reach even higher levels, rates that triggered the 2008 financial crisis and that modern homebuyers and tech companies simply cannot service. When sovereign nations are forced to liquidate massive assets to survive, it triggers widespread wealth redistribution across global markets. Are you positioned to benefit from these shifts, or are you exposed to the fallout? At Stewardship Finance Academy, we built the free Stock Investment Masterclass to provide a structured, rule-based framework for navigating these exact macroeconomic environments. You can click the link in the description to access the masterclass for free and learn how to align your portfolio with institutional capital flows. If the Federal Reserve truly intended to engineer a long-term yen appreciation, they would cut US interest rates to narrow the yield gap. Instead, US borrowing rates remain elevated, while Japanese rates are constrained around 1%. This keeps the profitable carry trade dynamics completely intact. To stop the bond bleeding while maintaining these rate differentials, Washington deployed the Fed's standing FEMA repo facility. This diagram shows the FEMA exchange. Instead of Japan dumping bonds on the open market, the Fed allows them to pledge treasuries as collateral in a direct transaction. In exchange, temporary US dollars flow back to Japan to cover immediate energy costs. While this prevents a disorderly crash in the US bond market, it comes with a massive cost for Japan. The catch to using the FEMA facility is the price of that liquidity. Japan must pay an annualized interest rate of nearly 4% on the dollars they borrow. Back in 2020, Japan purchased these treasuries at yields near 0%, effectively lending capital to Washington for free. Today, Japan pledges those exact same assets back to the Federal Reserve, paying a steep premium to access liquidity against their own national savings. The intervention successfully kept the global leverage model operational and protected the US debt market. But it did so by permanently eroding the equity on Japan's sovereign balance sheet. With pressure continuing to mount across East Asian currency and stock markets, global capital is already searching for its next revaluation target. Build your framework for these volatile conditions by joining the SFA Free Stock Investment Masterclass today through the link in the description below.